think one of the flaws of traditional retirement planning, traditional financial planning, is that oftentimes it does not spend enough time, pay enough attention to the tax impact. Many people today are concerned that, well, what if my tax rates are higher in the future? Traditional financial planning focuses more on, well, how do we increase your gross before tax income? What's really important is how much money do you have to spend at retirement after you pay your taxes? And when you start thinking about how to be more tax-wise about retirement income, it's important to realize that almost all of your resources, the money that you have available to fund your retirement, is going to be taxed in one of three different ways, which I'll represent here with three different buckets. You've got your currently taxed bucket. This might be vehicles like your bank CDs or maybe bonds that you've got, maybe some dividends that you get from some brokerage accounts. Anything basically that generates a 1099 each year where you have to report that as taxable income. The problem with currently taxed vehicles is that if you're using them to accumulate retirement funds, you want that money to stay in there and grow. Well, if every year you got to take some out to pay taxes, over time that's going to really inhibit the ability of those accounts to grow. That's why a lot of people like a tax postponed account. This would be things like your IRAs or your 401ks or any of the popular workplace sponsored retirement plans where the taxes are deferred on the accumulations. Now, the problem with the tax postponed accounts basically is that we know we're going to have to pay taxes someday. We're deferring the taxes today. But at some point, and that's when we withdraw the money, the taxes will be due and payable. And one of the biggest concerns is, what will the tax rates be at that time? If they're high, this could be a problem. If they're low, it won't be a problem. Then we've got this last category, tax advantage vehicles. And in this category, I'd put things like Roth IRAs, certain forms of permanent life insurance. It's a few other vehicles, but very limited. And basically, if there's a flaw or a concern about these tax advantaged accounts, there's a lot of rules that must be followed to receive those tax advantages. The money is growing inside these accounts without current taxes. And at retirement, we have an opportunity to withdraw this money and not pay any taxes as long as we follow those rules. So when people look at their retirement income in the future and they start thinking about being more tax-wise about that income, you should look at, well, how much of my resources do I have in each of these buckets? And all too often, people end up with most of their resources in this bucket. That might be okay if their tax rates are lower in the future, but it could be a big problem if they find that their tax rates are higher in the future. So if this is something that's of concern to you, it's definitely a topic that you might want to bring up with your tax professional. You might want to start looking at strategies. Is there a way? How could we start moving money from this currently taxed bucket to the tax postponed bucket? Or maybe even better, how do we move from the tax postponed to the taxed advantage bucket? Being tax-wise about your future sources of retirement income is a real key, and that's why I spend a great deal of time on that topic in my book, How to Avoid a High Wire Retirement.